With silver, you had that spike up the last couple days of January, and part of it was Wall Street bets. Part of it was actually institutional investors riding the coattails of Wall Street bets.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update, and with us today is Jeff Christian from the CPMGroup. Now, one of the things that we really like doing is having guests on who have alternative points of view. You know, the truth speaks for itself. So if you watch all of our interviews, we want you to have kind of all these different points of view and you can make your own decision on what you believe. So with all that being said, a lot of the things we're talking about in this interview with respect to gold and silver manipulation are not the views of Miles Franklin, but we want to have Jeff on to share that alternative point of view. And we really appreciate your time, Jeff.
It's good to be with you.
Definitely. It's great to have you. And I really wanted to get your take on today's price action in the precious metal markets. They're both heading higher, and then kind of looking at the greater context of the past week or so, the crazy price action we've seen, especially in silver.
Okay. Well, today's an interesting day because you have stocks, bonds, the dollar, oil, gold, silver, other commodities all rising. And in our morning meeting, when we were trying to discuss, what's going on here, I guess the consensus view was that there's a market expectation that there will be greater, sooner fiscal stimulus programs in the U.S. and in Europe and in China, and that monetary accommodation will continue to be extremely loose. You saw a weak jobs report on Friday, and that sort of factors into that, along with the Democrats saying they're going to go it alone if the Republicans don't want to come along. So I think that was sort of pushing everything up today. If you look at gold, price has sort of been in a range of really 1800 to 1880, but you could say 1780 to 1880 because we had that spike down last week. And it moved from 1784 to 1800, 1815 last Friday, 1840 today. We think it's going to be in that range for a while. Our morning call this morning was 1845 and then probably come back off and test 1820 later in the week. And yeah, we did see prices stronger. With silver, you had that spike up the last couple days of January. And part of it was Wall Street bets. Part of it was actually institutional investors riding the coattails of Wall Street bets. And one of the things that we saw was we did see a surge the last two trading days of January in silver trading volumes on the futures and options in the SLV. But the preliminary data that we've seen suggests that a lot of the buying is actually institutional investors who saw what was going on with the Reddit group and said, well, if these guys are going to try to push the price up, let's ride along. And the market's there. It's funny you talked about the wider context of what that is. What we were saying last week when people kept asking us to explain what was going on, what had gone on, because it was really a 4-day event, 2 days up, 2 days down, was that you had to take that in a broader context. If you look at silver, for example, silver prices kind of trading sideways to slightly higher from September into the last couple of trading days of January. You had a stronger silver market going into that. And that's part of the reason I think that some of those guys were looking at silver and saying, hey, this thing could pop. It could be pushed higher. And you've seen strong growth in investment demand for silver and gold 2020 into early 2021, but mostly in 2020. I mean, you saw investors buying 3 times as much silver, physical silver, last year as they did in 2018, 2019. And probably about more than double the amount of gold that they had bought in 2018 and 2019 in 2020. So you've seen an upward shift in the investment demand curve. Investors have looked at the state of the world and they were buying more gold and silver already. And then you had that 4-day aberration. So we look at it as a 4-day aberration but it was in the context that you do have the prices moving higher, at least on a long-term basis.
It's really interesting what you said, how like Wall Street bets, maybe, is this kind of characterizing your view that maybe it was the catalyst, or in some way was the catalyst, but really institutional investors kind of piggybacked on that wave? Kind of, if you wanted to unpack that a bit more, what happened last week?
Just looking at preliminary data that we've seen, it looks to us as if the Wall Street bets guys, and the same thing actually seems to have happened with GameStop too. There are reports that institutional investors may have made hundreds of millions of dollars riding GameStop higher in a wave that was started by these retail investors saying, hey, let's gang up and push the stock higher. And there are big differences between it. So it's just based on the preliminary data that we're seeing. But what we saw was, these guys started saying, well, let's see if we can do in silver what we did in AMC and GameStop. And when they did that, and it was all in public, people were watching the Reddit feed and they saw, these guys are pouring into silver. Let's take silver positions. And so what you saw was a greater increase in the volume of open interest held by institutional investors than by retail investors.
And then why didn't we see the same kind of reaction then that we saw in GameStop? We saw GameStop go from, like 15 to, almost 500 or something like that. And then with silver, we only saw, a 10% jump and then it went back down. What is your perspective on why we didn't see a similar reaction to the price in the silver market?
Well, there are a couple things. And one of the points that we've made repeatedly over the last 7 trading days is that, silver is a commodity and commodities are not stocks, and there are radical differences between them. And one of the things is that in a stock like GameStop, you have naked shorts. You have investors who have borrowed the stock and sold it with the expectation that they'll be able to buy it back at a lower price. And they're naked shorts. There are some naked shorts in silver and other commodities, but the vast majority of shorts in commodities, futures, and options are covered shorts. So if you look at the commitment of traders across commodities, what you find is that the vast majority of institutional investors and retail investors tend to be long, because investors, generally speaking, are more comfortable being long than short commodities or any asset, and that the shorts are commercials. And a lot of those shorts that are commercials are futures and options hedges of underlying physical markets. And that's particularly true in gold and silver and platinum palladium, where you have a lot of metal that is leased out to processors and fabricators and semi-fabricators and manufacturers by financial institutions like banks and bullion dealers. So you have this large physical position that is owned by banks and dealers, and they tend to hedge that. In most cases, they're required by their financing sources to hedge that position, and they use primarily futures and options to hedge that position. So I think one of the mistakes that the Reddit boys missed was they saw, and they said, there are 610 million ounces of short commercials in the silver futures and options contract, and another 150 million ounces of institutional investors. That's a massive short position, and these guys have been saying that this is going to blow up in the shorts face since at least 1986, 1987. So maybe it'll happen now. Let's try for it. And they didn't realize that 610 million ounces is almost entirely hedged and protected, so that you don't have the naked shorts that have to run in and get covered. GameStop, you start buying, you go long, and all of a sudden the shorts start covering, and you have short covering, which amplifies the upward move. In the precious metals markets, a lot of those shorts are already covered. They are, in essence, the covers of long positions elsewhere. So their owners are price insensitive, except that as the price rises, they make more money, because in the physical market, they're making money on fees. And a fee at $30 is 20% greater than a fee at $25. So they're actually benefiting from rising prices. And they don't necessarily need to hedge because they're already fully hedged. You do have the institutional investors who are about 153 million ounces of shorts going into the last 2 trading days of January. They will delta hedge. So as the price starts rising, they will start, if they're short futures, they'll start buying options to cover it. If they're short options, they'll start buying futures to cover their shorts. And, our calculation was that by $30, they would be 100% delta hedged, and they were. So the price stopped. And the Reddit guys, who primarily were retail people trading stocks, did not understand the difference of the dynamics of shorts in the commodities market. The other thing which we still have to sort out, and we being the broader market, is, silver and gold, they trade on CFTC regulated futures and options contracts. They trade in the SEC regulated SLV and GLD and ETFs, and they trade in the unregulated US OTC market and the OTC market in the UK, which is the FCA regulated. So you have a hybrid market there, and you have competing regulations, SEC regulated ETFs and CFTC regulated commodities. And that all has to be parsed out, because I think that a lot of regulators are looking at what happened and saying, well, does this hybrid nature of commodities that have underlying or have derivative ETFs, does that hybrid nature lend itself to this kind of mistake?
With respect to that, you're saying essentially that the commercials are short silver a lot, but then it's hedged with physical positions. Where can people go to actually look at the physical positions that the commercial has?
You can't. That data is not really available. It's first off, let me correct one thing. The short futures and options are not hedged with physicals. The physical longs are hedged with futures and options. But for the fact that they are physical market makers, they would not be short the futures and options. So you have to understand the prime move, the prime motivation of those guys. They're long physical silver because they're market makers, that's their business, and they hedge that with futures and options. Those physical positions are OTC positions on a global basis, and none of that is reported. In the UK, you have the FCA that regulates the OTC market, but open interest broken down like that is not publicly available. It's not, I'm pretty sure it's not privately available too. And then in the United States, it's also an OTC market that's fully unregulated, so there's no data on that. You only find that data from people like CPMGroup who go off and make estimates based on their industry contacts and experiences.
I guess if it's not publicly available, how can we say for certain that the short positions are actually hedges of physical positions?
Well, first off, you have knowledgeable people like me saying that. The second thing is the people who say that those are short, naked shorts, have been wrong for 40 years. How many years of having your thesis disproven day in, day out does it take before you say, maybe my thesis is wrong? How many times does somebody have to say, oh, these short positions are going to blow up in somebody's face, and then it doesn't? And by October of 2012, silver is going to be $300 an ounce because of these naked shorts. And then it's November, and then it's 8 years later, and it still hasn't happened. People who say that they're shorts have been consistently wrong in their analysis of the market, and they've been proven wrong by the price. So why would you believe them?
I think one of the things that people point to is, the argument is that the price is continually being suppressed, right? And you look at the market and you see in different timings, right? For example, around the 10 a.m. Eastern, 3 p.m. London time, you see often the price will drop. It's also argued that there are specific times that are low volume, right? And you see a whole bunch of selling at those times. They look at the market and see that the way that the market is running isn't like a normal market.
Okay, there's several things that are inaccurate in that statement. And we've disproven this statistically over the years, over and over again. First off, if you look at, you're talking about, 3 p.m., 10:30, whatever, you're talking about the London fix. And there are all these people who say, well, the London fix, the morning fix tends to be relatively stronger than the afternoon fix. And the afternoon fix, you tend to see the price fall. And there's a very, oxums rather, there's a very obvious reason for that. A lot of producers, smelters, and refiners sell on the fix. And they go into the fix, the afternoon fix, not the morning fix, because a lot of them are actually based in North America, and they want to sell their production while they're in the office. The morning fix is too early, but the afternoon fix, they're in the office. They've had a chance to have a cup of coffee, look at the markets, figure out how much they want to sell, and they place orders to sell. So there is a lot of selling that occurs at the afternoon fix on the part of producers. And that's why the price tends to come down at the fix. It's a, if you will, organic, or it's a readily understandable function of the physical market. Now, there were some other things that you were saying, and I will tell you that, yes, there are people, and it's interesting, you use the term suppress, which is the wrong verb. Because suppress, I guess, suggests some sort of desire to keep the price down on a long period of time. And what you will see, and I'll give you a couple anecdotes that actually support this. What you will see is that people know that the period in what we call the New York pre-open, London's at lunch, New York hasn't opened, and that tends to be a very thin time of trading. And I'll give you a couple anecdotes, and they go back 20 years. And we've published these anecdotes, and we've talked about them in public, and we've been in reports. So it shouldn't be a surprise to anybody who actually reads about precious metals. One of them was, there was a gold producer, and we were talking about how, yes, in that morning New York pre-market, the market's vulnerable to large orders, up and down. And you see this not only at the pre-market, but also in the actual market on up days and down days. If you actually look at it, you'll hear all these people, oh, if you look, there are all these times when you have these outsides, 1 million ounces of gold sold in a 5-minute period of time, somebody's slamming the market. And you look at that and you find that those periods of excessive volumes on the COMEX actually occur more often on the upside than on the downside. And it's not a single entity. It's usually hundreds and sometimes thousands of entities who are all using the same computer to generate computerized buy and sell signals. And they're all looking at the same price. And the price will cross a threshold and trigger a wave of sales or purchases. So it goes both ways. And it goes both ways in the pre-markets. But my first anecdote is that we used to talk to the producers, the mining executives, and we say, yes, the pre-market is a very vulnerable time, and people come in and they'll hit the market in the pre-market, and you'll see the price down $40 or you'll see the price up $40. And then New York opens and it's back where it was. And one of the producers said, that's funny because I'm talking to my banks and they're saying that I can get off 200,000 ounces of gold easily, if I want to do a forward sale. And he called up one day and he said, you win. I said, what do you mean? He said, well, I called up my bank and I said, I want to do 200,000 ounces of forward sales. And he said, okay, the bank said, let us work it. It'll take a couple of days to put 200,000 ounces in place. He said, no, you said I could do this all the time. No, we need, in order that large, we have to work. So the market was a lot less liquid than the bullion dealers were telling their customers, the producers. He said, you're right. They said, we're going to work this over 2 days. You can't get just a 200,000 ounce thing. Now, another producer did the opposite. He had he had several 100,000 ounces of forward sales, and he went into the New York pre-market and he called his bank in London and said, I want to buy back 600,000 ounces of my forwards. And they said, okay, well, New York will be open in a half hour and we'll start working that order. He said, no, I want it right now. And the price of gold that day shot up like $40 in the London pre-market. And he called me up and he said, you're right. And I just taught the banks that it works both ways. So you have a very illiquid period of time, and people throughout the market, at least informed people throughout the market, know that, and they can come in. And it's not that they're trying to suppress the price; they're trying to take advantage of the illiquid market. The same way that the GameStop longs said, "Here's an extremely illiquid market, and if we pool our money together, we can push the price up." Another example, years ago, because again, and this goes back to the issue of the SLV versus the exchange traded futures and options. Futures open up at 8:30 and the stock market opens up at 9:30. There was an institutional investor several years ago that had a long GLD position that it wanted to liquidate. The price was down, lower than it had wanted to sell at. So one morning we see a wave of buying in the futures market at 8:30, which drives the gold price up. And at 9:30, there's a wave of selling on the GLD. And by 10:30, the price is back where it started before COMEX opened. So this is a trader who's arbitraging. He's saying, I want to sell my GLD. I don't like the price right now, but if I buy futures at 8:30, I'll take out some stops, trigger some buy orders, drive the price up, and then at 9:30 when GLD opens up, I can sell it at a higher price. And he did. And I don't think that's actually illegal in the eyes of the regulators and the rules of the road in the stock market and the futures market.
And I think one other thing, just before we let you go, just one other question kind of with regard to this is people point out how it seems like the rules can be changed mid-game, essentially. How, we saw last week when silver spiked, margin requirements were hiked, right? And we don't see that kind of thing happen when the price falls very fast. We only see it when it rises very fast. That's the argument.
Two things about that. First off, I was around with the Hunts and actually knew the Hunts and talked to the Hunts. Nelson actually said I was the last guy in Manhattan that he talked to. There were people who said, they changed the rules. No, they imposed the rules because on the COMEX, there is a rule that says that if the market is getting out of hand and excessive, and you see this in all these different markets, that the committees within the exchange can impose such regulations as required in order to protect the financial stability of the broader financial market. And you see this with, these automatic stops in the stock market, where if the trading is too volatile or the price moves too far, too fast, they stop trading, they halt trading for a little while. And the liquidation only orders that came in on the COMEX silver and the CBOT silver in 1979, during the Hunt silver purchases, those were not creating new rules, they were imposing rules that were already on the books. With the margins, there's a gruesome misunderstanding on the part of casual observers of the markets as to what's going on. There has never been a major default in a U.S. futures exchange. I think there was a potato default in the 1970s when NYMEX traded Long Island potatoes. But that's because there's a clearinghouse. The clearinghouse makes sure that all of the members have the financial wherewithal to cover their positions. And the members then are required to make sure that their customers have all the financial wherewithal. And one of the problems with GameStop 2 weeks ago was that Robinhood had a real sloppy system of clearing, which allowed the customers to game it and basically build up much larger positions than they had the financial wherewithal to cover by virtue of the fact that Robinhood's clearing system wasn't really properly set up. But the exchange, the futures exchanges have pretty good clearinghouses, and they've never really had a default. And the reason is that they have these margins. Now, as the price rises, those people who are short will have to put up more margin, and they have to prove to their customers, their brokers, and thus to the clearinghouse that they have the financial wherewithal to cover their financial obligations given their short positions. You have a similar situation on the downside, but as the price falls, the dollar value that's needed to cover those positions declines. As the price rises, the dollar value of covering those positions increases. One of the things that the Hunts did wrong was, as the price was rising from $10 to $50 prior to December 1979, it peaked in January of January of 1980. As the price was rising, they were collecting margin because they had long positions, and as the price rose, their margin account was growing. And they took the money out of relatively liquid at the time silver futures contracts, and they invested it in less liquid stocks. Texaco, Beige, Halsey, Stewart, Shield stocks, all kinds of stocks. And then when the price was falling because of the liquidation only orders and other factors, they had to put up margin. And they had taken their margin money and put it into less liquid things. So when they finally had this liquidation only order because they failed to meet a margin requirement, it was because they failed to meet a margin requirement. There were a couple of reasons, a couple of mistakes that they made. But one of them was that they had moved all their margin money into less liquid stocks. And you saw the stock market fall sharply that day because Beige, its trader, its broker, had to sell a bunch of stock in order to raise the money to cover the silver margins. So the silver margins, I think, are grossly misunderstood by casual observers who don't understand that that is the mechanism that assures the financial stability of that contract. And it's worked very well. And as the price rises, the stakes of covering your short positions increases.
All right. Well, Jeff Christian, we really appreciate your time today and sharing your insights. And we love to get everyone's perspective. Before we let you go, did you want to share with the viewers where people can find you online?
You can find us online at CPMGroup.com. You can buy our gold, silver, platinum yearbooks, and you can find other free reads on our website. We have videos that we're producing now pretty much on a weekly basis, sometimes a couple times a week, short commentaries on what's going on. And there's a video library there, and you can find those also on YouTube.
Awesome. Jeff, thank you so much for your time.
It's always a pleasure.